Good afternoon and welcome to the Spotlight on Ferrous. We appreciate you being here and hope you enjoy this session. My name is Greg Dixon. I'm the CEO of Smart Recycling and I'll moderate this for you. I have the great title of outgoing Ferrous Chair, which is always a good one to have, even though I've enjoyed doing it. At this time, I'd like to introduce our counsel to you, and he'll review the antitrust rules and regulations.
On the echo.
Thank you, Greg. Just want to remind everyone to keep the antitrust laws in mind. ISRI has a great booklet on that, provides good background on the antitrust laws, basic do's and don'ts and best principles. The main bottom line is for the panelists and then any questions from the audience to avoid discussing any company-specific pricing, price trends, et cetera, and to keep it away from those areas. I'll be here if anybody has any questions. Please let me know.
Thank you so much. We have three really good speakers for you this afternoon. The way that we'll conduct this session is each one of them have a presentation that they'll present, and then after that we're going to go into a Q&A session. There are microphones in the audience. These lights are very bright, so if you do go up to a microphone, you might want to wave at me or something just so we make sure we see you, but we will take questions from the audience as well. Our first presenter is Phil Bell. Phil is the president of the Washington-based DC Steel Manufacturers Association, the SMA. He represents 25 North American EAF steel producers and over 100 associate member companies across the U.S., Canada, and Mexico. SMA members account for over 75% of domestic steelmaking capacity and employ over 60,000 people. Approximately 2/3 of all steel made in North America is made via the EAF process, and the SMA serves as a voice of the North American EAF steel industry. It's my great honor to ask Phil to come to the podium. Thank you.
Appreciate it. Well, good afternoon, and on behalf of the SMA, I'd like to thank ISRI for the opportunity to share ideas with you and to participate on the panel with Sean and Nathan. We've got a lot of ground to cover, so why don't we just get going? For me, my outline today, I'm going to tell you a little bit about the SMA, just a couple of quick slides. Going to talk a little bit about the domestic EAF industry and what's going on there. We'll take a quick look at GDP and global steel supply, as well as steel demand and their demand drivers. Then we'll talk a little bit about restructuring and capacity, particularly capacity utilization. I think in the backdrop of what's going on in the domestic steel industry right now, we need to truly understand how we have a lot of capacity that has not been used, but now appears to be poised to come back online, and a lot of new capacity that'll be introduced. Then I'll talk about the interplay between scrap, iron ore, and ore-based metallics, and then we'll wrap things up by taking a quick look at 232. Just to tell you a little bit about the SMA, we represent 25 steel producing members. We make over 3/4 of the steel in the United States, and SMA members operate in 43 states and 115 congressional districts. Our mission is very straightforward. Our idea is to advocate on behalf of 21st century steelmakers. In other words, to help people in Washington, to help the media, and to help people around the country and around the world better understand what EAF steel production is and who 21st century steelmakers are. That could be anything from our Vice Chair Mark Millett testifying before Congress, Barbara Smith, President and CEO of Commercial Metals on the Fox Business Network, talking about 232. It could be Kevin Mullen from Sterling Steel hosting Congresswoman Sherry Bustos at his mill, or it could be SMA staff giving briefings to folks from the Department of Commerce or the Office of the United States Trade Representative. Make no mistake, EAF production is the most dominant steelmaking process in North America, and that trend is going to continue. Currently, about 2/3 of all steel is made via the EAF process. That's projected to be over 68% by 2025. Also, this is a kind of highly stylized and overly simplified slide that shows the geographic footprint of EAF producers in the U.S. What's important to note here is that the green dots represent the mini mills, the black dots represent the integrated producers, the red dots represent rolling mills, And the gold dots represent ore-based metallics. And you'll see a couple of dots in Ohio that didn't exist when I put this slide together last year. One is the recently announced Cliffs HBI plant outside of Toledo, and then the other one is a plant in Lorain. Then in the purple, you'll see new EAFs that have come online in the last couple of years. Most notable, of course, is Big River Steel in Osceola, Arkansas. You have CMC with their micro mill in Durant, Oklahoma, where they're going to make spooled rebar. And then there have been recent announcements from Nucor about facilities, bar mills in Missouri and Central Florida as well. When we look globally, though, make no mistake, it's still a blast furnace picture with about 75% of all steel globally being made via the blast furnace. But we do see some growth trends. And we also see a lot of capacity, even in places like China, that has been taken offline is being replaced by EAF production. Taking a look at economics real quick, the GDP picture globally for the US isn't that bad. It's projected to be about 2.5%. That's certainly short of the 4% that a lot of people would like to see and what a lot of models use in order to justify things like tax reform. But 2.5% GDP growth in an economy that is as large and diverse as ours, that's okay. The idea here is to keep it going and to sustain it. Globally, though, I think a country that really needs to be looked at closely is India, with an anticipated GDP growth of about 7.5%. And also, India has become a major player in the steel industry in a very short period of time. They just recently passed Japan as being the second largest steel producer in the world. But make no mistake about it, steel production continues to be dominated by the Asian region. When we look at global steel demand for the NAFTA region, we see a modest uptick, according to World Steel, of a little over 1%. Things seem to be a little flat. For some reason, steel demand does not seem to be tracking with the overall economic growth that's being experienced globally, but still 1%, 1.2%, that's in the positive, right direction, and we'll take it and work with it the best we can. Looking very quickly at some demand drivers, automotive still has legs. Although automotive production will be down in 2018, it's still anticipated to be close to 17 million units, which is a very good clip. When we look at manufacturing, there still is a very positive sentiment among manufacturers in our country. The Purchasing Managers Index hit its highest level in 14 years back in February. And anytime that's above 50%, that's a good sign. And you can see that the trend line is going in the right direction there. Infrastructure spending, I'll just talk briefly about that, is something that we're holding out hope for. But the real question is how we're going to pay for it. And with the recent tax cuts and some of the inertia in Washington, we're not so sure if infrastructure is going to come around or not. But we'll keep our fingers crossed to see. When we look at construction, we can see that U.S. housing construction spending is kind of flat, but it's still the largest market for the steel industry. So it's something that we will monitor very, very closely, both in the residential and non-residential sectors. Now I want to talk a little bit about the steel industry in general and restructuring. And a lot of people point to China's reduction in excess steel making capacity. Depending on whose numbers you use, it could be anywhere from 150 to 165 million metric tons that China has just gotten rid of. But there's a couple of things that they don't tell you in those statistics. First and foremost, those aren't net numbers. So at the same time China is reducing excess capacity, they're also adding capacity. Some of it is even projected to be EAF capacity. And what a lot of people also don't know is anywhere from 100 million metric tons to 115 million metric tons of that capacity were induction furnaces that weren't included in their original capacity numbers that they were reporting to the OECD. But anyway, they said they were going to do something, they put together a plan, they did something, but I think it's very important to look at those numbers with a grain of salt. But when you really want to talk about reducing capacity, When you really want to talk about restructuring your steel industry, you need to look no further than the United States of America. Here are 3 restructurings that have taken place over the last several decades. The first took place in Europe between 1980 and 1986, and about 20% of the capacity was reduced. And you can see in Europe that their capacity utilization went up from 63% utilization to 73% utilization. Not bad, but that was a very bureaucratic, managed, government-driven process. In the US, we had a major restructuring between 1982 and 1987, where we reduced excess capacity by 27%. And that was done based on free market principles, bankruptcy laws, real mergers and acquisitions, not just in name only, and the ability for entrepreneurs and risk takers to go out there and see what they could do in our industry. And you can see that our utilization went up from 48% in 1982 to 80% in 1987. And then you have China, which, with all of the hoopla about their restructuring, only reduced capacity by about 13%, and the numbers could be considered suspect. To look at it another way, this slide represents the number of US steelmakers who in 2000 had in excess of 2 million tons of capacity. Those names look like a stroll down memory lane. There were 22 companies in this country that had capacity, steelmaking capacity of over 2 million tons. You fast forward to today, and that number is just 10. And you can see them right there. So if you ever want to know how to reduce excess capacity, you don't need to look to China. You can look right here at home. Now this slide here, I'm going to really need you to focus on that blue line. But this tells the story of what's happened in our country when it comes to capacity utilization. And it's also a slide that sets the stage for why we have a 232 situation in the US right now. If you look from 1995 to 1999, steelmaking capacity utilization rates were consistently above 85%, which is generally considered the optimal capacity utilization rate. At this rate, you can run 4 shifts, you can do some CapEx, you can do a little R&D, and you can even make a little money, heaven forbid. In our country, we've had 2 major steel crises. The first one occurred between 1999 and 2001. And if you look at the utilization rates during that crisis, you might scratch your head and say, well, is that really a crisis? Dipped slightly below 80%. But as a result of that crisis, you saw a lot of things happen. There were a rash of bankruptcies. There was very robust M&A activity. And then the Bush administration initiated a 201 safeguard to help the industry stabilize. And lo and behold, with those 3 things, plus a generally healthier economy, look what happened to utilization rates between 2002 and 2007. They were back above 85% consistently. Then we had our second major steel crisis. This occurred kind of coincided, if you will, with the global economic crisis. So from 2007 to 2009, you can see capacity utilization rates dip. And by the way, this is utilization rates for EAF, integrated, all product lines. In fact, some people were in the mid 50% range. Some were even lower than that. Keep in mind, this is an average. But something very unique happened this time. The Bush administration and then the Obama administration decided, you know what, we're not going to intervene here. Domestic steel industry, if you think you're being harmed by foreign imports, knock yourself out. Go file trade cases. And that we did. And we had a pretty successful run. We won a lot of those trade cases, and we got some very big margins on a lot of those trade cases. But look what happened. Capacity utilization did not rebound like it did the first time. In fact, it hovered in what many call this new normal, kind of in that 70 to 75% range. In fact, we haven't been at 85% capacity utilization in over a decade. Some would call that a lost decade. And so lo and behold, after the elections of 2016, President Trump launched a 232 investigation. And one of the stated goals of that investigation by Commerce Secretary Wilbur Ross was to bring capacity utilization rates in the United States back to 80%. I actually think it should be 85%, but we'll take 80. So this set the stage for what we have today. Trade cases alone were not enough. Global forums on excess capacity were not enough. Bilateral and multilateral meetings were not enough. So let's talk a little bit about 232. The 232 is a national security steel tariff, and back on March 8th, President Trump signed it, made a proclamation, and a lot of people thought it was the biggest and baddest proclamation you could make. A 25% tariff on all products from all countries. And lo and behold, within hours after the proclamation, all of a sudden we began talking about possible exemptions for national security reasons. What about our NAFTA partners? 90% of the steel we export goes to Canada or Mexico. There's cross-border ownership, integrated supply chains, raw materials, semi-finished and finished products cross those three borders all the time. Also, what about special products? So they talked about a product exclusion process. But one of the things we do know is that after the investigation was wrapped up, they had three major findings. One, that steel imports threaten further closures of domestic steel capacity, and they would shrink our ability to meet national security needs. That excess capacity and unfair trade practices by foreign steel producers contribute to that threat. And again, as I mentioned earlier, the U.S. needs to be operating at 80% capacity utilization. Well, after March 8th, just a little while later, on March 22nd, the president issued another proclamation. And this additional proclamation said, you know what? First of all, NAFTA is exempted, okay? So Mexico and Canada, you're fine. Australia, you're fine. And if the urban legends in DC are true, Australia found out about this at a cocktail party. But anyway, there were countries that, due to their national security relationship with the U.S., were temporarily exempted from 232 tariffs, depending on how well they're able to negotiate with the United States government. So these include Argentina, Australia, who found out at a cocktail party, Brazil, Canada, Mexico, South Korea, and the 28 member states of the European Union. Now, we don't know if these will be long-term or not, and they'll be based on their satisfactory ability to show some alternative means to remove threats to the U.S. steel industry, to deal with excess capacity, to combat transshipment and circumvention. But you have to understand that this is on a very fast timeline, and supposedly, unless there's another proclamation, this is supposed to be all wrapped up by May 1st. And that's a little hard to do when you have a 301 going on, NAFTA negotiations going on, and a very dicey geopolitical climate right now. Now, when you look at those countries that are temporarily exempted, that represents about 65% of all of the steel imports in the United States. And I'll never forget when the 232 report came out, the phones at SMA were ringing off the hook. Member companies were getting calls from their customers. What are you going to do? This is crazy. Is this fair? But as you can see, this is a multi-layered process that kind of started here on one extreme and seems to be regressing back to something that's much more reasonable, with exemptions, with about 65% of imports potentially excluded. And that number could change. It could go up or down. This isn't done yet. But this kind of shows how fluid the situation is and how willing the administration is to kind of shift shapes when necessary. Also, I want to make it perfectly clear, because there's a lot of confusion about this. I was at a conference last week in San Antonio where someone asked, hey, are raw materials part of this 232? They are not. This is finished steel products and semi-finished billets and slabs. So ore-based metallics, scrap, iron ore, not part of this, just to clarify. Now, how effective is this? How effective is it going to be? Well, we already see new investments. U.S. Steel is bringing back Granite City. Although a lot of those announcements that were made about new capacity were made kind of before the 232 got more specific, the fact is steel companies are ready to invest. They are ready to invest in their people. their processes, their equipment, and in new facilities. And it's not just because of the 232. It has a lot to do with regulatory reform as well as the tax cuts. So let's take a look at the impacts of 232 on various sectors. And first and foremost, this is the ISRI conference, we have scrap recyclers. The general thought process is that the 232, whatever becomes of it, should be positive for you guys. But there is a little bit of uncertainty because it could affect those scrap processors that rely heavily on exports. But we think your pricing should go up, and we think this should be a net positive for you. If you're a steel producer, absolutely it's a net positive. If you look at stock prices, if you look at profits, I think everything would be fine. Manufacturers, probably those that are consumers of steel to make products, not so much. They did wage a very good lobbying effort, and the exemption process will help them quite a bit, as well as that list of countries that are exempted. But overall, we think that will be a negative. And then finally, the end consumer, probably negative, but it depends. It depends on how much of that cost is passed on to them, and do they really need to pass on that cost? A good example that a lot of folks use is the cost of a $40,000 car. And they said even with these tariffs, the cost of that car should only increase by anywhere from $150 to $300. Well, who knows if that's true or not, because I always thought the cost of a car had to do with what kind of upgrades you had, how long you financed it, you know, how you can haggle. So I think you have to wait and see how this plays out for the end consumer. Then another thing that I think is important to note, and this slide was done by Vince Papalardo, a friend of mine. And I think that you need to understand that after the election, it really didn't matter what sector of the metals industry you were in. You've done pretty good since Trump got elected. It didn't matter if you were a service center, an EAF or an integrated steel producer, a specialty metals company, scrap processors, even big global companies like ArcelorMittal. Everyone has done reasonably well. In fact, they actually did better. Things didn't start getting volatile until the 232 actually became a reality. But the point I make is that since the election, the metal sector has done pretty well. Now it's something that's very important. Now that things are going good, guess what happens? Everybody wants to restart a mill, call people back, and even build greenfield facilities. And I'm not going to pass judgment on any of these products because I believe we are in the freest, most robust, and most open steel market in the world. I also feel that there's been enough unused capacity to meet increases in domestic demand. In fact, that's been the big problem. Domestic demand has not been that bad, except most of it has been gobbled up by unfairly or illegally traded imports. But here's some of the new steelmaking capacities that have been announced within the last year. Acero Junction, Charter is putting an SBQ mill in Cleveland, Commercial Metals in Durant, Steel Dynamics is investing CapEx to increase their rebar capacity at their Roanoke, Virginia facility. NLMK is restarting a hot dip galvanized line. Nucor has announced 2 greenfield facilities, one in Missouri to take advantage of the Midwest market, and another in Central Florida, which is a very robust economy. Republic Steel is talking about coming back, and there's even talk of possible expansion at Big River Steel down in Arkansas. And I might even be missing a few here, but this is important to note. Things are looking up for domestic steel producers. Also, I just want to talk a little bit about iron supply to steel makers by type, and we want to look at it over the last 10 years. And when you look at it, first I'll say this, that scrap will always be the primary raw material import for EAF producers. Make no mistake about that. But you see a trend emerging here, and we're going to talk about that for just a little bit. Number one, you can see in 2008 that scrap made up about 40% of the supply to steel makers. It's about 43 today. Hot metal was 33. That's dropped significantly over the last decade. But you've seen a pretty nice increase in ore-based metallics. And I think that's something as scrap producers, scrap processors, that ISRI needs to be paying a lot closer attention to. And I'm going to tell you why. Let's talk about EAFs and scrap. As I mentioned, scrap is going to continue to be the primary raw material for us, and it represents anywhere from 60 to 75% of the cost of liquid steel in the ladle. But obsolete scrap has become something of a challenge for EAF producers. It has a highly variable chemistry, and actually prompt scrap and ore-based metallics provide more chemical consistency for melt shop superintendents, and companies' abilities to meet customer requirements. Also, obsolete scrap is growing as an overall percentage of scrap. And that's not a good thing, because as lower quality scrap increases, higher grades of steel are being pursued by the EAF industry. And so EAFs continue to push more and more into product areas that just 20 years ago you wouldn't imagine they could make. And then I also want to talk about Chinese scrap, because it's kind of what I call off chronologically. During the great capacity expansion in China, virtually all of that was blast furnace. But now you have a country that has a very robust and pretty high quality scrap reservoir going. And the question is, what are they going to do with that? And are they going to get a sophisticated enough supply chain to do something? Are they going to keep it for strategic reasons? Are they going to export it? Are they going to start having enough EAFs to make it meaningful? And then just another challenge that we face are residuals. And this slide it's a lot simpler than it looks. If I can explain it to you, you can understand it. But really on the y-axis, you show the different grades of scrap. On the x-axis, you're showing the residual levels. And then those red lines are showing basically what type of products can tolerate a certain residual limit. But as the quality of scrap continues to decline, you're going to see more and more EAF producers look to pig iron, ore-based metallics, and other things to meet their customer requirements. It's not a huge trend yet, but trust me, it's happening. And it's not just for people with high-end applications in automotive, flat-rolled, or SBQ. I have a member that produces wire rod that uses 25% ore-based metallics in their mix. And they say that the plant runs better and the quality is better. So something to think about. Current state of the steel industry, and this is my last slide. I think when you look at Section 232, it should be a net positive for steel producers and for scrap producers. You couple that with tax cuts, deregulation, and possible infrastructure investment, and that bodes well for everybody. But it's still a challenging environment. The 232 is very complex. We were online just this morning. I was talking to my team. There are over 3,400 comments that have been filed on 232, and about 2,000 of those comments are requests for exemptions. And some of those exemptions are even from domestic steel producers. There's a lot of market volatility, there's a lot of geopolitical risk, and the raw material supply chain still continues to be fragmented. So I look forward to the rest of the panelists' presentations, and I look forward to the Q&A. Thank you very much.
Thank you. Thank you very much.
Okay, you're welcome.
Thank you, Phil. Our next speaker is Sean Davidson. Sean is the global editor of Argus Metal Prices at Argus Media. He heads up the Argus Metals team, covering global scrap markets for years in industry press. Since joining Argus, Sean has been busy cementing Argus as a leading provider of metals news, analysis, and market data. Argus price assessments are widely used for indexation of physical trade, starting in crude oil and products, but now natural gas, emissions, coal, fertilizers, and metals. Over the past 18 years, Sean has lived and worked as a journalist in the United States, United Kingdom, Middle East, and India. His career has spanned print, online, television, and social media. We welcome Sean.
Thank you. Thanks, Chris. Thank you. Thanks, Greg. Hello, everyone. Good afternoon. Thanks for being here. Thank you, ISRI, for having me here again. It's always fun being here and listening to all the opinions and understanding what's driving sentiment, both in the export markets and the domestic market. So I'll try to go as quickly as I can. My Indian blood makes me speak a lot faster. I'll try to slow it down. I apologize if you can't follow it. My accent's also a bit of a mongrel. I apologize in advance. So yeah, I mean, this is the regular disclaimer. It says I have no idea what I'm talking about. This is what we're going to discuss just very quickly, a wrap on the export markets, the domestic markets, and just some of the near-term trends that we've heard from all of you here and those that chose to sit down at the bar and drink quite wisely. So this is who we are as Argus. For those of you that aren't aware, we've been around for about just over 40 years. The publication started in crude oil. We're very heavily indexed in crude oil, actually globally. The OPEC price is ours. The US crude oil price, every time you fill gas in a gas station in the US, you're using an Argus number. We're quite heavily used in petchems, jet fuels, all kinds of commodity groups. And our latest foray over the last 4 years has been in metals. Just a quick overview of our ferrous coverage, since this is what we're here to discuss. We cover ferrous, obviously, globally, but just in the US, as you can see, it's quite expansive. We are the only publication to cover markets like Denver, the Quad Cities, deep coverage of the Texas market. Our price histories for all these locations go back anywhere from 3 to 7 years. We've also never had a price correction or a non-market adjustment, and our prices are extremely accurate. We understand from market participants that there can be differences of $100, $150 compared to their actual purchases and sales and other publication numbers, not ours. So with that, let's talk about export markets. A quick review of 2017. Obviously, as a lot of you know, 2017 was a good year for U.S. exports. It bounced back off a really poor 2015, a sort of moderate, okay 2016, and then we sort of bounced back 22%. Interestingly, even though it shows that Turkey was up, actually the first half of 2017 was quite rough in terms of exports to Turkey. It was I think it was almost unchanged for the first 6 months, but it bounced back in the second half of last year, just given a very strong rebar market, both in their domestic and export sales. What's really interesting here is the sort of rise of Asia. I mean, Phil mentioned it. We keep running into each other in China and India and other countries because it is. I mean, India, Pakistan, Bangladesh, but also Vietnam and China, increased their intake in 2017. I think obviously the big story for the U.S. has been the sheer dominance of Mexico, India, Pakistan, and Bangladesh on all U.S. coasts, and that's what makes it a really, really special sort of partner, right? Because you could be in any coast, and we'll talk about that in a minute. But I think that the key takeaway here is that the dominance of the sort of large market makers in the past, like South Korea of the West Coast or Turkey of the East Coast, in terms of their influence on the price, has diminished. I mean, 5 years ago to today, the U.S. is shipping about 4 cargoes less per month to Turkey, right? But Mexico can determine a U.S. East Coast FOB price, or India, Pakistan, and Bangladesh can. And the reason I say India, even though the exports to India have dropped, India tends to be, and I see a lot of the Indian buyers here, so I apologize, but they do tend to be a bottom-feeding market. But the point is that the trade into Bangladesh and Pakistan actually happens via Indian agents and Indian traders, because they've done all the hard work of establishing those relationships, both here, with the US and European suppliers, but also, in India, they know how to deal with the local agents, the local ports, the local corruption. So it is an extremely important partner to the US. Looking at just, how the U.S. exports, I mean, I get asked this a lot, I don't know why, but I mean, so we do a lot of analysis, and here's how it sort of looks. It's sort of evenly balanced between the West Coast and the East Coast. 42% of U.S. exports come off either coast. The Gulf Coast sort of accounts for about 10, 11%, depending on the year, and the rest is Canada. You guys will get all these slides, so I'll just move on, or you can meet me after this and I'll send them to you. So yeah, just very quickly about Turkey. Of course, at the end of the day, the sheer volume that Turkey buys makes it the dominant player on the East Coast. But I thought what was very, very interesting over the last sort of year and a half, is that you can see that when the Indian subcontinent is quite strong on demand, container FAS prices will compete very, very well with bulk FOB prices. So it's a difficult market to stay on top of in terms of understanding what's driving demand in that region. The fundamentals of steel trade in Bangladesh are extremely different from the fundamentals of steel trade in India. In India, the ferrous prices can get moved quite significantly by its stainless steel producers rather than its own mills. And Pakistan, of course, has different fundamentals. What I would like to share, all of you, for those of you that are interested in knowing current price levels, today, Turkey book cargoes at 345 and 355, for the same quality of HMS. And that's quite interesting because these sanctions on Rusal have weakened the ruble, which has made Russian sales of US quality scrap actually quite competitive, even at 345. So it's an interesting market to watch. But just going back to a point I did want to raise here is that, it used to be maybe call it a year and a half back. The Turkish market's very transparent because of the sheer number of agents and brokers that work in that market. So, you would get, every day that Turkey would book a cargo, 3 cargoes, 4 cargoes, from Russia, Europe, UK, the US, it sort of gets sent out and everyone receives, this is the composition, this is the buyer, this is the seller. And, you could use that to sort of, within a very close sort of proximity, get to estimating the supply. How much supply has actually left the East Coast, how much supply has left the UK, how much supply has left the ARA region in Europe. And over the last sort of like 12 months, it's actually, obviously, it sort of impacts the buyer or the seller depending on the trend. And they've become a lot, let's say, they've closed out some of the information. So we've been tracking it, and it is our estimate now that about 20 to 25% of the tons that are sold to Turkey every month are not reported. So if you are one of those companies that tries to estimate, let's call it East Coast export volume, I think it's safe to estimate that about 20 to 25% of the volume goes unreported. And then, of course, in addition, there's all these other markets that we're shipping to, right? Mexico, Peru, Ecuador, Brazil. We go to Greece and Italy and Spain off the East Coast, and of course, and also the Indian subcontinent. So I think, if you're trying to use that data, when we are trying to estimate supply every month, I think we use a figure of about 30 to 35% going unreported. If that helps you in your business decisions, that might be a good number to look at. On the West Coast, on the East Coast, Turkey does drive the volume. On the West Coast, it's really anyone's game. Some months it's Malaysia, Indonesia, Vietnam booking. Some months there's, you're going to Kuwait, Bangladesh. Every month it's a bit different. It's been a lot harder for the West Coast exporters. I could see some of them here, and you have to applaud the effort that the West Coast exporters have put into really tapping new markets, working with mills in other regions to sort of explain bulk trade to them, how it works, working with them on the ports. There's been a lot of effort that's gone in to sort of making other markets more open to receiving bulk. Bulk is a huge risk, right? When you're booking it. But it is extremely diverse. China remains a big buyer of US scrap, even though people talk about China like, oh my God, China's going to export scrap. Yes, they did in September, October. The volumes were insignificant. For 1 or 2 months, it sort of caused a disturbance. Japan was able to ship to the US, and Japan was able to ship to Bangladesh. But overall, the volume out of China right now, it's not as significant as the total volume of trade. For those of you that are looking at current prices, India is at about 390 CFR for container shred. India's booked a bulk cargo 385 shred off the West Coast this week. I'll quickly jump into seaborne imports. Again, last year was a good year for people that were exporting to the US. Scrap iron imports went up, pig iron imports went up. Overall, it just essentially helped keep the market in balance. We had outages at the Nucor DRI plant. Exports were on the rise. You couldn't get pig iron out of Russia because of the geopolitical issues that they had for about 5 months. Brazil supply got shut out for about 4 months. So overall, we had to bring these units into sort of balanced demand and supply. The sort of trend has continued. pig iron imports only sort of recovered at the end of last year, and they're up significantly in the first quarter this year. So let's talk about the U.S. domestic market. There's three main themes, obviously, that everyone here has been sort of looking at for the last few months. The first one, of course, being, we've started the year at higher prices. I mean, this should come as no surprise, but, that slide tells you, what you already know. The second is, this was the most interesting thing, wasn't it, last year? The spread between busheling and shred. I mean, these are, of course, just using our national averages and our national indexes, but in some markets, the spread was as wide as $100, right? Quite fascinating to see that, by April already this year, we're back to around a $13 spread, which actually in many markets makes shred more expensive on a yielded basis than busheling. And April, of course, as a lot of you will know, the market was sort of weakened. The initial anticipation was 30 and 40, and the people that didn't believe the markets would rise by 30 and 40 probably were more in the, yeah, this market should rise 20, 25, because every U.S. mill is running strong, there's good demand. And then the lack of exports of both the West Coast and the East Coast sort of hurt sentiment in that bye week. And instead of rising, for example, by the expected or the hoped 20, 25 bucks, it rose by 10 or 15. Still pretty strong if you come to think of it. And then the last one, of course, is the metal spread between finished steel prices and scrap. It's right now at about 550, 560, depending on the location. That's on a dollars per gross ton basis. This one's a tough one, isn't it? I mean, we're in a market where hot roll is at, whatever, 860, 880, 840, right? And you've got busheling, shred in that sort of 380, 400, 410 band. And yes, the spreads are wide. We are in a market where the U.S. steel trade is sort of protected. And it means that, essentially, everyone's trying to guess, okay, fine, which one gives first, right? Will steel prices correct and come back and bring, the metal spreads to a more sort of traditional $250, $300 spread, or will scrap go up, right? I think a lot of you sitting here in the room probably think that scraps, for that to happen, scrap would have to go up, what, $150? A lot of you would love to see that. But it's sort of, I don't know, it's interesting. We talk to a lot of companies, and many, we've received a varying amount of sort of views on how this will sort of pan out. I don't think there's any consensus actually on how this is going to work. Does it mean that we're just going to stay in a $350, $400 sort of metal spread range for a while, which gives raw materials maybe a little uplift and means that sort of steel prices have to come to about a 700, 750 level. Like Phil mentioned, I think 1st May is actually extremely important, right? both from a perspective of, okay, fine, what happens to scrap prices just in the May trade, but also what happens to steel production for the rest of the year, what happens to, to scrap demand for the rest of the year, because, if they don't like the way these deals are, are negotiated and the administration is not getting its way, and it sort of says, okay, fine, look, we gave you a temporary exemption, but it's back on. That means that it's more bullish on the finished steel side. So that's a huge sort of cause for uncertainty, if you like, a sort of swing factor in the May trade. And I think the other piece of it, of course, is how much are we going to export off the East Coast in the next 10 days? So this is just a quick snapshot of some of the things we've discussed already. I will mention, of course, the one thing here is the transportation. For the last 6 months, it has been incredibly sort of almost, on our side, it's really frustrating because we really feel terrible for the industry, when it has the scrap to sell, for example, but it can't ship it because it can't get rail cars. Or, the river's really high and there's like shred trapped in Chicago that can't go, and now suddenly a mill's running short on scrap. And, it's been incredibly hard to move scrap by, on the river, to get rail equipment, to get trucks. You'll hear from not the choice, not the best language. People are just irate with certain railway lines, with certain trucking companies. So if there are, logistics people here, I would sort of implore that, you understand the pains here, because it is sort of universal. Yes, okay, fine, west of the Mississippi for the last 2 weeks, rail has been a bit better, sure, but everyone's struggling with this. It's a bit ridiculous that we have such a large industry that's, processing scrap, selling scrap, melting scrap, making steel, and everyone's struggling with transportation. At some point, something's got to give because it's a bit ridiculous right now. So yeah, so I mean, that's sort of like where we are. Obviously a lot of these, I've just put a few slides together on talking points for the next couple of years. Phil's already mentioned a lot about the new capacity additions. So I thought I'll just talk about a few points in certain regions. I think in the Midwest, obviously, there's a lot of there's some rumored activity about will this producer add more capacity? Will this person expand capacity? Obviously, Cliffs doing the DRI plant in 2020 will be a big game changer. Metal X putting that shredder in Delta, Ohio is going to be fascinating. And then every time the river gets disrupted in the south, guess where they're going? They're going to the Midwest for scrap supply. So, a lot of you sort of trade in regions where you're not, you're so far removed from the river market that you think it's not important, but I think it's becoming a much bigger sort of player in price decisions and price making. So, it is something that I'd encourage you to sort of keep a closer eye on. In the East, of course, I think the big ones are, well, you've got Georgetown will come up again, with the Liberty acquisition. It's 30,000 tons. They're going to do rebar. You've got the micro mill coming up in 2020 by Nucor in Florida. Mingo Junction's interesting. What they decide to do with that production could have an impact on steel prices, on hot bands, so that's something to keep an eye on. And then, of course, every time the Turkish market's not booking scrap, that scrap's getting offered to the Ohio Valley, the Southeast, like it did this month, and it sort of has quite a significant impact on trade. And then on the river market, if Big River Steel launches phase 2, that's a significant change. Anytime the Mississippi is disrupted, either high water or low water, that's quite a significant event, actually, if you look at the amount of scrap that's shipped on the river. So that's something to pay attention to. Granite City, from what we hear, will probably bring back about 50,000 tons of capacity in the third quarter. And then, of course, you've got Nucor in Missouri coming up with the micro mill in 2019. And then, just very briefly on Texas. I think Texas has actually become quite an interesting market, right? You've got CMC with the plant in Durant. Beaumont has new ownership, which tends to change how scrap is purchased. And then you've got JSW talking about an EAF install in Baytown. So suddenly, this sort of Houston, Dallas, so those little dots are how we cover the market. So we've combined Houston and San Antonio as one delivered mill market. We treat Dallas as one delivered mill market. So these are markets that we assess. And then for Houston, we have a weekly export yard buying price and a dealer FOB price for scrap that goes up the river. That's how we assess it. And we're finding that the competition for trade, for scrap, and that, like this month, Houston in the local market had some of the strongest prices for HMS, and so did Dallas. In the near term in Texas, I think something to keep an eye on is essentially what happened with that Hurricane Harvey scrap. We pride ourselves in the amount of analytics we do on supply and demand, and I thought I'll share this with you. So, where our America's headquarters are in Houston, it of course impacted a lot of us, sort of personally, and a lot of the people that we work with. But, we started to look at all the Hurricane Harvey numbers and we were trying to determine what is this impact? Like, how much scrap does this actually bring in? Very credible, large mainstream media organizations were talking about 500,000 damaged cars, 1 million damaged cars. It was utter nonsense because, it was nowhere close to it. What we did is we got in touch with the auction houses and the insurance companies, and we said, right, how many cars, because in the aftermath of Hurricane Harvey, in the first 2 months, you had about 70,000 to 100,000 tons of scrap come straight in because these are uninsured cars, underinsured cars, and obviously all the scrap from houses that come straight immediately into the stream, right? Everything else, so we basically figured that it was actually around 350,000 cars, not the 500,000, not the 1 million, but just 350,000 cars that were damaged. Most of them are insured. So what that means is it goes and sits on auction lots, it sits on sites, they have to go through this very long, rigorous process, and then once it's done, which these companies have announced happened at the end of the first quarter, so now they've gone to companies that will now strip it apart for parts. A lot of you recyclers, you know how this works. You're only sending the car body to the shredder, right? Everything else will get stripped out. Parts that you can reuse, all the non-ferrous, everything that you can get out of it will go out of it. So we actually think that a lot of that supply actually hasn't reached the processing. So it is our estimate that, you probably have about 150,000 cars. I'm just looking at my numbers right now because I don't want to mislead you. But so with IAA and Copart, they've said that they've sold most of their vehicles in the first quarter of this year. So that's about 150,000 cars sold and about just 15,000 cars that are left to be sold. That takes the total to about 200,000 cars that have been sold in sort of the first quarter. It takes about 4 to 6 weeks to go through the whole parts processing and then reaching the shredder eventually. So, and it will happen in waves, right? It's not like suddenly in like whatever in June you're going to have like, the 3 or 4 Houston shredders like just rammed with, 200,000 tons of scrap to process. That's not how it will work. It'll sort of be a slow bleed, 20,000 tons, 30,000 tons, but this supply is coming. I think with that, yeah, just a near-term outlook, what does May do? Right now, we've spoken to a lot of people, and they think the market's sideways, soft sideways. There's also a case for like an up market. Like I said, I think everything right now about the May trade depends on 2 things: what happens on first of May with the trade cases and the exemptions, and also, of course, how much scrap does Turkey book over the next 12 days from the U.S. Not so much the price, but the volume. Overall, mill demand is expected to stay strong through the rest of the year. Construction seasons, post-Ramadan as they kick off in different regions will sort of boost demand. And I would like to share, this is something that's sort of happened more recently, is the Zorba aspect of the sort of Chinese tariff of 25% as a tit for tat against the Trump administration. Again, it's something to keep an eye on. Right now, it's our estimate that it's had maybe an impact of about $8 or $9 per gross ton on a shredder feed price, the drop in Zorba prices. At $380, $400 shred, okay, not a lot of shredders are concerned, but in 2015, 2016, we tested what is the price point at which shredder feed stops. We know now that it's about $110 to $130 per gross ton, and that means that should there be because we're in such uncertain times, such volatile markets, should something go south in the U.S. and steel prices fall or scrap prices fall, if along with that comes this massive drop in Zorba prices because the Chinese smelters are no longer getting the rebate, on Zorba imports as they sell ingot to Japan, or, it impacts all aluminum scrap grades. So, if that changes and the shredder in a weak pricing market for ferrous can't recover the margin on its non-ferrous, then guess what? It will be forced to have the steel mills recover that margin. So it's just something to keep an eye on. It probably won't happen, but again, it's just something interesting to look at. In conclusion, this is a quick summary of the things we discussed. With that, I'll stop here. I hope you were able to follow me a little bit. Yeah, that's me. Thank you very much.
Thanks, John. Our next speaker is Nathan Frucker. He is the founder of Automotive Trading Company, an independent trading company that handles ferrous scrap metal and other recycled products. With over 3 decades of trading, shipping, and logistics experience, Nathan has pioneered scrap exports from several new geographical areas and developed lasting business relationships through volatile and fundamental changes in the industry. He is known as an old-school trader and is a trusted partner to many scrap recyclers and steel mills around the world. It's my pleasure to welcome Nathan.
Thank you. Thank you. Good afternoon, ladies and gentlemen. Thank you very much to ISRI to give me the opportunity to address you today. I'm not going to tell you anything about my business, about my company, because I recognize many familiar faces in here today. Many of you have traded and worked with me, and many of you who have not worked with me. And for those of you who don't know me, feel free to come over to me afterwards, introduce yourself, give me a business card, then I'll give you mine. So without giving you any menus, what we're going to talk about today, I'd like to see a show of hands. Who here has a pet peeve? Something in the industry that bothers you, that troubles you, something you like to fight, something you would like to be fixed, whether it's transportation, logistics, warehousing, positions, government regulations. Can I please see a show of hands, ladies and gentlemen? Okay, so the good news is you're not in the minority. We all have pet peeves, and I have a big one as well, and one I'd like to share with you today. And not because it affects me, but it affects many of you here, not only in ferrous scrap or in other scrap products, but also in probably most commodities worldwide. So without further ado, I'm going to delve right into this. You sell a cargo of 2,000 tons of scrap in containers, or you sell a bulk vessel, 30,000 tons. You get yourself a respectable buyer, and he opens up his letter of credit, and after 2-3 days of going back and forth, you've cleaned up all the amendments that are required in the letter of credit. You get yourself a confirmed booking for the container, or you charter a ship. You send your trucks to the port to pick up the empty containers. Your supplier loads them, or you are the supplier and you load them, and you take them back to the port on time by the deadline. And you got yourself everything. You followed all the rules. You played by the rules of the game. Life is perfect. Nothing could be better. By Friday, 2 o'clock, all your containers are in the port. You get a confirmation from the terminal that your containers are there, and the cutoff was 5 o'clock, so you're happy. Life is perfect. And then on Monday morning, all hell breaks loose when your broker calls you and he tells you, I have good news for you and I have bad news for you. And he goes on to explain to you, and this is how you feel when you hear him say to you, I have good news and bad news for you. What has happened here? Your shipment was booked for the 29th of March. That was going to be your sailing date. And the shipping line decided they're not going to call in the port. The vessel is being repaired somewhere in one of the other ports, or for whatever reason, the voyage was canceled, and your containers were now forwarded and moved forward to April 7th. So you went from a March 29th sailing date to April 7th. The broker feels good. He knows he did his best to get you onto the next voyage, but you don't feel so good because you have a latest shipment in your letter of credit of March 31st. And to make things worse, the market has dropped $25. So now what? Can you force your buyer to take the merchandise? Your buyer is protected. He opened up a letter of credit to you, and you are not able to present clean documents to him. Simple as that. Don't even think of asking the shipping line to backdate the bills of ladings. It doesn't happen these days. It's all on the computer. So your buyer's protected. You're not protected. You're out on a limb. So what I've wanted to do is, how do we get this resolved? How do we fix this? Maybe we start by creating a hashtag, protect seller. Or actually, more realistic, you need to include certain clauses in your sales contract to protect you from this. So, for example, you insert a contract clause that protects against a ship delay that is beyond your control, or a timely container drop-off date in the port should be considered if there is a delayed bill of lading date. And in order to obtain payment against your original bills of ladings with the letter of credit, with a letter from the shipping line confirming that the containers were dropped off before the original booking cutoff time. I consulted with a friend of mine who is my LC guru, and I managed to trash through some ideas. But I still feel I came up with some kind of a clause that I proposed that every seller should include in his contracts. Basically, the clause would read, bill of lading dated after latest shipment date is acceptable if seller presents a letter from the shipping line confirming that seller's original booking number and scheduled sailing date was no later than the latest LC shipping date, confirming that the seller's booking was pushed back by the shipping line due to operational or other reasons beyond seller's control, and seller completed its drop-off of all containers before the cutoff date for the original booking. These are conditions that I propose the industries should adapt in order to secure themselves against vessel delays that are beyond your control. Now you can say to me, oh, but we've had sales contract for so many years and they're standardized, it's very difficult to introduce a new clause. That is true, you can, but there are certain times in the market when prices are up and your buyers need the goods, those are the time to protect yourself and to insert these clauses. There's other such cases, but I limited my presentation to only one case today. So in my opinion, every seller should have this kind of clause, and it's really for your own protection. There's another thing I'd like to talk to you about now, and that is the subject of Ferrous future contracts. There's been a lot said in recent years of trying to introduce Ferrous future contracts to our industry, which is very much a physical commodity. It's the person you know, how well you know him, how well you trust him, is his price structure and guideline correct, is he in touch with the markets or not? And I cannot tell you how many times in my 35-year career have my bosses or my superiors or even myself and my colleagues looked at each other in despair and said to each other, why don't we have an exchange that could protect us from certain losses? You take a position and the market did not always go the way you expected it to go, or you took a risk, you stuck your neck out, and you cannot slow down your losses. You are on an endless fall. So today we've been blessed. There are 3 existing ferrous scrap future contracts, and I'll briefly touch on them. The Chicago Mercantile Exchange has a U.S. Midwest busheling ferrous scrap contract. They've introduced it in 2002. AMM is the price provider. This is a recent chart I pulled off the internet. Then you have NASDAQ recently launched the U.S. Midwest shredded steel scrap. Price provider is also by AMM. Here's some figures I pulled off the internet. So when you look at these 2 products, who should be buying these products? Who does this affect? So I had a quick look at the US map, and yes, both are Midwest, and therefore you automatically assume that it's all the interior states of the United States. But technically, any trader, any dealer across the United States of America can and should and could buy with this, could peddle with it. But I don't really see any overseas dealers or traders or steel mills wanting to get into this product. And the third future contract that we have available today is the London Metal Exchange offers an HMS 8020 contract in bulk to Turkey. It was introduced in 2015, and that price is provided by S&P Global Platts. So here's a chart how that price has developed in the last approximately 2 years. And you can see here the volumes they have traded. Clearly, February 2018 was their most successful month with 549 lots. Now, who is interested in these contracts? So let's look at the map. Right away, you see the exporting states from the United States, where all the exporters are on the East Coast, in the Gulf, and on the West Coast. If you look at the countries, this affects other processors, this affects overseas. Obviously, it affects the United States exporters, mostly the East Coast, but also the West Coast, because we have seen recent years cargoes from the West Coast going to Turkey, the Canadians, as well as the Europeans, and then some of the old Eastern Bloc countries like Latvia, Estonia, you see them there on that list. If I take this a step further and I want to look at who are the buyers of these contracts, who are affected by this, who could play this, who could work on this, you're going into, of course, Turkey, Greece, Egypt, Saudi Arabia, Kuwait, Qatar, and the west coast of India, which buys its crops usually off the east coast of the United States. Then you have Mexico, Peru, and Ecuador. If I take it a step further, put all the suppliers, processors, and steel mills together on one map, these are the countries and the dealers and the companies that are somehow touched by this LME contract, that could look at it, that could play it, that could use it to their advantage. But then you have countries that are not directly linked, countries and markets that are not directly linked to the HMS 8020, and that is also the United States, some of the West Coast suppliers that sell to areas beyond, and I mark those countries in red. You have Japan, Korea, Taiwan, China, and you have also Southeast Asia, Indonesia, Malaysia, Thailand, etc., and also some of the South African tonnage, the Australian, and the Pacific tonnage. Those guys, those suppliers or those buyers aren't really so directly linked to this HMS contract. So until we get an Asian ferrous scrap futures contract, which doesn't really exist, what's happening here now is you are really splitting this market in two. You're going to have one part of an industry, one part of the market that can and has a futures scrap pricing and index pricing. You're going to have another part of the market that just doesn't have it. So what needs to be done? There was rumors that SGX was toying a bit with the idea of creating an HMS 8020 contract to Taiwan in containers. They decided to shelve these plans. Honestly, I don't know why the Taiwanese Stock Exchange hasn't picked up that idea and ran with it, because that would be a good contract to have to cover some of the Asian requirements. And then last week I was talking to my colleague Sean on the panel, and we felt there's a missing link, and Sean obviously suggested that there should be also an Indian price. So as you can see, in India, there's no shortages of exchanges that could offer an Indian ferrous scrap futures contract. Question now, should it be a shredded contract or an HMS 8020, or should it be a bulk or container contract, or maybe one of each? But there certainly is room, in our opinion, for that, for such a contract as well. So a quick look, how do you know which contracts should be offered? How does an exchange choose which contracts to offer? So if you look at today's price market indications, any of my people I work with calls me, he says to me, Nathan, what is the market at today? Knowing where he's located, he will either expect me to tell him the last Turkish deal done, or he will in bulk, or he will expect me to tell him the last Taiwanese price in 8020. And that's really what I call the market indicator. But the market indicators weren't always the Turkish CNF price in bulk and the Taiwan 8020 price. If I can take you back to 1980s, the market indicators at the time were the Korean CNF price for HMS number 1 in bulk from the United States. There was a Turkish FOBST price rather than for shredded. Yes, that was the market. Why FOBST? Because the Turkish government at the time used to give 30% rebates to old mills who would charter Turkish flag vessels. Of course, they all did their own chartering. The contracts were bought on FOBST basis, and that's how business was done. So that was a market indicator then. Had there been a futures market in the 1980s, I could have suggested, yes, you should offer an FOBST rather than contract. Then you had the Indian tenders for MSTC. Those tenders were all in bulk, and they were priced in Swiss francs. Why were they priced in Swiss francs? They were priced in Swiss francs because the interest rate for the Swiss franc was much lower than the US dollar rate, and the Indians were used to buying all their contracts basis 180-day payment terms. Fast forward to the 1990s, the Korean price is still there. The Turkish CNF price, the Turkish FOBST Rotterdam price becomes now a CNF price because it was a new government. They did away with this 30% rebate, and therefore there was no advantage anymore to chartering a Turkish flag vessel, so they decided, let's let the seller charter the ship. And then the Indian contract switched to US dollars because the interest rate for US dollars and Swiss franc became more, was at the same level already. So had you suggested Ferrous future contracts in the 1990s, I would have said to you, these are the contracts you should follow. So now that we know, and yeah, if I take it to the 2000s, we see the emergence of the container prices in Korea and in Taiwan. So that's where the idea of a CNF Taiwan or Korea price for containers comes. So now that we know that we have a choice of certain future contracts, how do you revolutionize the scrap industry? How do you go forward? How do you try to move, to create this movement and to push future prices? Does it work? Does it not work? It's a debate. There's good arguments on both sides of the divide. And so the question now is, who is our target? Who should be buying these Ferrous future contracts? Who should be using them to their advantage? So the way I've done some homework in the last year, I've spoken to many people in this arena, and the way I look at it today, this is how I feel about the financial institutions. They are shooting blanks. They're talking to isolated supplier A, to steel mill B, to a trader. They're talking left, right, and center to people, not knowing really who they should be talking, who they should be addressing to, and how they should focus on the subject. So the question then is, who should really be using this? Is it a steel mill or a recycler? In my opinion, it's definitely the recycler. Why the recycler? It's very simple. A recycler buys smaller lots from more sources. The steel mills sell larger cargoes to fewer buyers. So there's more price movement while collecting scrap, so there's greater inventory and price risk. Also, the Turkish mills, they sell rebars, then they go out and they buy the scrap at the levels that fit the sale. They can apply pressure to the buyers to move the price up, and they can also apply pressure to the recyclers by staying out of the market for weeks on end, like they are just now in the process of doing. They've been out of the market for like 4 or 5 weeks. There's some recent deals have been done, but we all agreed that they've been out for so long. So they really have what we call the upper hand here. Also, over the years, I've heard more recyclers complain to me of unsold stocks than steel mills, and I speak to both about equally. And basically, let's call a spade a spade. As a recycler, when a peddler comes into you and he wants to sell you scrap, and the Turks aren't buying anything, what are you going to tell him? I'm sorry, I'm not buying today because the Turks aren't buying? You don't have that luxury to do that. Because the minute you tell him, I'm sorry, I can't buy a scrap today, no problem. He goes across to your neighbor, to your competitor, and he sells it to him, and he'll probably never come back to you. So you do have to take his scrap, but you don't know what price to offer him, so you're not sure about it. So if you bought basis an index pricing, at least you locked in that material. You know you're going to have the material, but you don't know at what price you're going to sell it. So that's why I believe, in conclusion, that recyclers should be the ones using these future contracts even before the steel mills. So I have a few specific examples I'd like to give you, but you have to forgive me. I have to get a drink of water here because my mouth is very dry. Thank you. So I collected 6 examples that are real examples that have happened to either companies I worked with on a deal that I worked with, or to specific companies that have happened over the years. Some cases are known, others are not. Obviously, you'll follow along with me. So case number 1, who do I target to use these future contracts? The seller, the leader of the pack who sells, when the guy who rushes to sell, as soon as he sees the market is dropping, he runs to sell because he's insecure, he's not sure. He's a guy that should consider it. Case number 2, the longest stockpiler in a falling market. There's a famous case that I know it happened in 2012. This supplier had 140 to 160,000 tons of scrap on his berth, on his dock. Scrap prices in Turkey were just over $400 when prices started to fall. Mr. Prices will come back, refused to sell. He wouldn't hear of any advice from nobody. And sure enough, prices came down. Then they moved back up to $380 about 2 years later. And he still refused to sell, insisting, we will see $400 again, I'm going to sell in the scrap. I actually visited that pile at some point in there, and there were rats living in the pile. That's how bad it was. But still, he refused to sell. Finally, in 2016, he started to sell some of the material, replacing it with cheaper scrap. He finally sold it at a dramatic loss. There was the price difference in the range of $200 to $270 a ton. So how did this end? Very conservatively speaking, let's just say he had 140,000 tons. He lost $130 per ton on this, and that's rough. That's a cool $18 million. And then I haven't even said anything about financing costs, aggravation, credit lines tie-up, and all sorts of other nonsense. Lesson learned, your first loss is your best loss. I'm not saying that Walter Goldstein invented that, but Walter Goldstein was my mentor and the guy who taught me this business. And the first time I heard it is when he hired me in 1984. Case number 3, the nervous seller. Many times you have a seller who would like to take a sale, but he's nervous, doesn't know what to do. So here's an offer I got recently, a few weeks ago. I got an offer from a supplier. He offered me 15,000 tons HMS 8020, 5,000 tons PNS, and he offered me 2 to 10,000 tons shredder in their option, exact quantity to be nominated by March 14th. Why did he offer me an option on the shredder in his option? Because he doesn't have a shredder. He's a processor. He processes HMS 1 and 2 8020. He's got cut rates, but he needs to go out into the market to buy his shredded. So not knowing whether he can cover in the shredded to give me or to sell to me, he makes me an offer on Wednesday, March 7, confirm the business on Thursday, March 8, but he has the option to declare by Wednesday, March 14th, whether he's going to give me 2,000 tons of shredded or 8 or 9 or 10. Ladies and gentlemen, no seller should have to go through this nervousness. Every seller should feel comfortable and secure when he takes a sale. He shouldn't feel insecure about it. Next case, a big stockpiler. There are suppliers that have a habit of stockpiling 200, 300, 400,000 tons. We've seen it over the years. Those guys go through big market moves, $20 to $50. I don't have to tell you what kind of damages that can cause. Case number 5, a supplier with multiple smaller load ports. And here, in order not to show that I am pinpointing any particular processor or supplier or country, I asked my 5-year-old nephew, David, pick a country, and he picked France. So I pulled up a map of France. If you are a small French supplier, for example, that has several yards across the west coast of France, and you accumulate small tonnages over several periods over 2-3 months, then you need some type of security. You know you will have the scrap to sell in 3 months from now. You're buying it, but you don't know at what price are you going to sell that scrap in 3 months from now. Or for example, if you're a Japanese processor and you're all over the Japanese coastlines on both sides, you collect scrap over a period of time, you need to know at what price you're going to sell your scrap when you buy it, and therefore a hedging mechanism comes in handy. Like I said, this is for guys that have 4 to 6 load ports, and it takes them 2-3 months to accumulate the cargoes. So how do you set out to convert the industry? How do you get people to actually go from a physical pricing to accept an index pricing? So the way I'm looking at this and having spoken to people, there's a serious disconnect. You got the financial institutions on one side, you have the recyclers on the other side, and the bridge, they're not connecting. There's a disconnect there. In my opinion, my recommendation to the financial institution is learn the physical ferrous market. Get away from your desk, put on a pair of boots and jeans, and go walk through the scrap yards. Learn the industry. Understand every player, his strength, his weakness, the problems he needs to deal with, his pitfalls, whatever problems he has, understand what he got. Can we go one back, please? Thank you. Understand if there's a natural disaster that affects his business somehow, or if, don't rely just to read publications, although all the publications we read today are good, but know the industry. I said in the beginning, this is a physical business. You have to understand it and know it. And my recommendations to the recyclers are, learn to trust some of these future traders who can help you improve your balance sheets. There's a lot of good talent out there in many of these financial institutions. I've been fortunate enough to meet many of them in the last year because I made it my mission to meet them and to understand this part of the business better. And try to drop this psychological resistance to go along with index pricing. Give it a try. Dip your toes in the water, then walk into your ankles. Nothing will happen if you buy 500 tons or 1,000 tons. And yes, or you lose a few dollars on it. You've lost money on in other ways that you weren't prudent. Try it out. And you are doing, and think about it, most recyclers are already doing this on the non-ferrous. What is the big deal? Give it a try on the ferrous. There you have it, ladies and gentlemen. I hope you thought this was interesting. Thank you very much for listening.
Thank you very much, Nathan. Well, now we're opening it up to little Q&A sessions. And once again, if you have a question, please go to the mic. We'll start with some of the ones that we've got, and hopefully we'll touch on some points that are of interest to you. One of the big problems right now that's facing our industry is transportation. As you well know, there's all kinds of problems, name it. Railroads, shortage of trucks, problems getting containers. So it's not a domestic problem, it's not an export problem, it's just a problem. So I'd like to get a little feedback from each of you on where you see what's going to be happening in transportation, say, in the next year.
Well, the first thing I'll say is dealing with Class 1 railroads in some markets is like being forced to give a bad waiter a big tip. They're just hard to deal with. And you have a situation where they don't have enough cars or the types of cars that can haul scrap or steel for that matter. They're not responsive. They go back on their word. I think what you're going to see is the use of more trucks, but even there's a challenge because of hours of service rules and things like that. But you're going to see more trucks, the installation of short line railroads to try to help you, where you just run your own rail cars if you can get that kind of setup and the proximity you need. But it's a tough situation. I know at the SMA we're working very closely with the Rail Customer Coalition. We were a founding member of that group. We're looking at Surface Transportation Board appointments. We want to continue to keep the heat on CSX, but it's an uphill battle, I'll be honest with you.
Yeah, I mean, from everything we hear, it looks like essentially the answer, the solution is investing in it yourself. So companies that can, are looking to buy their own cars, rail cars, whether it's 5, 10, 15, or if you're a bigger company, buy 100. Obviously, these are very big investments, but that's what companies are being forced to do, and they are doing it. I mean, we're in an environment right now where if someone has the ability to, for example, barge, they're making the investment to build out that, that dock that hadn't been, whatever, looked at for years, right? People making investments in rail cars. I mean, it's an incredibly difficult situation, and like I mentioned in during my comments, I mean, it's quite kind of unfortunate, isn't it? This is a very efficient industry, and when it's something like that, that sort of impacts trade, and that can, see a mill not get scrap shipments, you don't want to run out of scrap, ever. And when it's not really just a buying strategy, but it's logistics related. I mean, when it's weather related, obviously everyone here, even mills, understand that. But when it's when it's not related, when it's a tariff, when it's a rate, when it's when it's other factors that are not sort of beyond your control, makes it extremely hard.
Sure. Nathan?
I agree with Sean. Be the master of your own domain. Invest if you can into your own transportation. Go beyond the line of duty to try and make sure that you really control it. But unfortunately, like I pointed out in my PowerPoint presentation, you don't always control it. You are still dependent on other factors. But whatever measures you can take on your own, you should. And as far as you mentioned rail before, I think there's a shortage in this country, secondary railway lines. Many areas are really underserved because the big railway lines have pulled out. There's a great opportunity there. People should look at those areas.
A couple things, I'll kind of put them together. We talked a little bit about China starting up some new production. I'm curious to see what you think the impact that'll have both from the steel side and the scrap side here in the United States. And then also, let's tie into that a little bit about, Turkey and their unique buying habits of, it's always interesting to me when you read an article one day that says, oh, Turkey's out of the market, looks like they're going to pull the market down, and 2 days later, wow, they bought, 8 cargoes and it's up $5. So I'd like to get any comments you've got on that.
Sure. I'll defer to my buddies over here.
Yeah, I mean, you look on China, I think Phil was absolutely right. The big news is not how much capacity they're cutting back, it's about how much the actual net steel output is, right? And it has been on a rise. I mean, it's quite, I think, it's difficult in sort of what we do where we're meant to be sort of, very, very neutral and unbiased and things like that. But, I think, when the courts determine that there has been dumping, a lot of it is true, right? I mean, that's due process. There is absolutely a move to use more scrap. You will absolutely see scrap utilization in China increase. It's sort of two-pronged. One is they want to use more scrap in their blast furnace. There's a reason there's an export tax on Chinese scrap. They want to keep that scrap price sort of desirable, attractive, right, to the blast furnace shops. And they absolutely do want to increase EAF capacity. I mean, Phil's mentioned it, they have some projects that will be EAF based. I mean, look, every 10% increase in scrap utilization in China is 70 million tons of scrap. That's right. I mean, these are staggering numbers. And so people talk about, I mean, there's a lot of concern about the Chinese scrap pool and scrap reservoir and, oh my God, China has so much scrap and when they start exporting, it's going to tank the market. Well, if they did export all those tons, yes, it would absolutely drop the market. But when you're a country that's trying to raise your utilization rates of scrap, you want to keep that scrap inland, right? So, to answer that first question, yes, scrap utilization in China will increase. And this is basis every single conversation we've had. I mean, we've talked directly with the Chinese government. We understand that they're investing in more recycling plants. They're trying to grow scrap recycling as an industry to bring in, to sort of move some of those jobs too, right? So these are all things that are happening. It's very structural. About Turkish buying.
They're their own worst enemies, if you think about it. All these shenanigans they play, you're going to come in out of the market, out, in for 2 weeks, out for 4 weeks. It does nothing good for them and nothing good for the recyclers or for the sellers. It just gives these big swings. In the end, you have to accept, as a Turkish buyer, you will never be lucky enough to be the guy who buys at the lowest price when the market starts to move up, and you'll never be the seller, as the processor, who sells at the highest price. If they just kept on rolling and continued to buy, okay, so step out for a week, we understand that. They would be serving themselves better, and the whole industry would be better served.
Okay. Let me remind you, if you have a question, go to the microphone, and we'll definitely try to get you up.
I think there's a question.
The gentleman back there has got one.
Hello, my name is Frank Odom, and I want to thank you all for the time spent on this presentation. I have 2 questions. One is for the first speaker, and the second is to the second speaker. Now, my first question is, you said the scrap industry or the scrap is not part of the 232. Now, my question is, how is that possible when the finished product, which is tax and tariff, when finished, is part of the scrap? So how is scrap not part of it? Because I have customers that are waiting for me outside to ask me what are the impact of the tariff to their scrap. And he just said 232 is not part of it. Do I tell him that 232 is not part of it? So can you explain to me on that? And then on the second question to the second speaker, you said, let me go back to the first one. Logistic raises transportation fee to the producer. And where does the producer charge the fee? To the consumer, which is applicable to the scrap. The finished product has to have a way to charge the tariff. And where are the tariffs going to be going to the consumer? And to the second question, Mr. Speaker, you said the price for HMS from India is $390.
Shred.
Now, I don't want us to go home from here believing that the price for HMS is $390.
No, I said the current trade
Just
Oh,
a minute.
sir,
Just a
gentlemen,
minute,
right,
sir.
gentlemen, sir, we cannot talk prices here, okay?
No. I'm quoting what he said.
He can show a
I'm just
slide.
clarifying that it was shredded,
Yep.
not HMS.
Yeah.
Yeah, I'm quoting what he said. I don't want us to go home believing that, because that is not a right price without using the transportation, the FAS.
Oh, I see what
Most
you mean.
customers will go home and then believing that the market is this, but then it did not include the FAS price,
Sure.
which brings it very, very low.
Right, that's
Okay.
a fair
Those
point.
are my questions.
We got your points. Let's give him a question.
Sure, I'll answer mine real quick. Just to make it perfectly clear, raw materials are not subject to the 232 tariffs, okay? Following this gentleman's logic, I could see how you could indirectly say that scrap is affected, but raw materials are not part. The tariffs are on finished steel products, billets, and slabs.
Yeah, and on my piece, I'll just clarify. What I said was that in this week, we've heard of shredded sales into India at that price of 390 CFR Navasheva. So just clarify the Incoterm. It was delivered. The range this week is that we've received from market participants has been 385 to 390 CFR Navasheva for shred. Does that help, Frank? All right.
I think we have another question.
Gentlemen, good afternoon. My name is Marty Berkowitz from California. Quick question regarding 232 as far as scrap exporters are going. Is there any good sign, any good news for us with 232?
I think so.
Well, Marty, I think the good news is that the administration is willing to be flexible here. I think that there was a lot of concern initially about how extreme the tariffs would be, but you see that there's a very robust exemptions process in place, and there are also a lot of countries that are temporarily excluded and will probably end up permanently excluded. I think you also need to understand 232, all of the negotiations stuff are very interconnected. So a lot of this stuff gets connected to NAFTA. A lot of it gets connected to the 301 against China. A lot of it gets connected to geopolitical things that we need certain countries to do. So, you know, it's not the brightest picture for exporters, but I don't think it's as bad as people originally thought.
Yeah, I wanted to add something to that. I mean, there's a saying that from every bad thing, something good usually comes out. I don't like to make predictions because I don't have a magic ball, but there's certain scenarios I can see developing out of this 232 on the export side. So what I think may happen here is that U.S. domestic prices will be, on the East Coast specifically, will go much stronger and higher. And as a result, the U.S. East Coast exporters will look to command a better export price. And then the question is, will the Europeans follow? And will they also move their prices up gradually? Will the Turks allow them to follow or just hold back their buying again, forcing many of them to cave in because they can't finance their stocks for so long, and then there's financial issues or cash flow issues, and therefore they have to sell? And then the question is, or if they move it up, does that open up a door for new scrap movements? So what I think can happen here is that if U.S. East Coast prices go up higher and higher, The markets that are dependent on a Turkish price, for example, Egypt, Greece, Kuwait, Qatar, Saudi Arabia, Mexico, Peru, Ecuador, those markets now automatically need to pay a higher price as well for their scrap. And that may open up the door for suppliers that are, for European suppliers, for example, to start shipping to those further away markets if the Turks don't match that price and don't pay the high price to the European processors.
So we've got a little less than 30 seconds here, and I've got one more question I'd like to get in kind of as our last one here. But think about what the domino effects are in regards to the tariffs. And what I'm talking about is what is something that we haven't seen yet, an effect that may happen down the road, and what kind of effect do you think it could have on the scrap market, whatever that domino effect may be 6 months, a year down the road?
I'm going to tell you what I've been telling to everyone since this 232 business has come up. It's really uncharted territory. We don't know. I agree there are valid and respected opinions on both sides of the divide, but none of us really know. We haven't seen this before. So I wouldn't dare give a more firm answer on that.
Well, I mean, yeah, sure. You know, he's being a politician now. He's been said. You know, no one knows anything about tomorrow, right? But you know, I mean, I'll take a stab at it. I think, like, you know, look, like anything, you know, it can, if it does end up triggering, you know, an all-out trade war, you know, everything's, you know, up in the air, right? Equity markets, credit markets, you know, interest rates, all of it, right? Will it come to that? Most likely not. I think, you know, I mean, I wasn't kidding about the Zorba thing. I think, you know, that sort of like that trade war on aluminum imports from the U.S., you know, versus a sort of a U.S. ferrous market, I think that, you know, it could potentially have quite a lot of damage. I mean, again, I don't think it's a likely scenario, but that's one that I'd be watching sort of if I was a scrap recycler, essentially, you know.
Sure.
Steel side.
I think that's a good note to end on.
There you go. Well, gentlemen, we thank you for participating today, and thank you for attending. Have a good day.